A very warm welcome, ladies and gentlemen, to the Omaha Compass, the podcast where we navigate the volatile world of finance together in search of a wise investing compass. I'm your host. In today's episode, we're going to set aside the complex charts and the dry numbers. Instead, I'm going to tell you a story. A true story of a great fall, of a billion-dollar chess game, and of the wise few who found opportunity in the middle of a financial storm. This is the story of the oil market in 2025. Let's begin. The year is 2025, a year a seismic shock rattled the global energy market. The entire landscape changed with breathtaking speed. Crude oil prices, once firmly perched at the $100 peak, suddenly plummeted to just over $60 a barrel. Inventories that were once tight, a symbol of a world thirsty for oil, were now overflowing, signaling a dramatic reversal. Amidst this chaotic scene, a story of stark contrasts emerged. On one side, investors who lost billions, those who had mistaken a wave of growth for a permanent safe harbor. On the other, were the others, those who had quietly and wisely protected themselves, not only surviving but thriving in the eye of the storm. The core question now is not simply if oil prices could fall. Markets, after all, are always in motion. The real question, the billion-dollar question, is this. Is this decline merely a temporary correction, a brief stumble, or is it the opening chapter of a structural recession, a tectonic shift that will reshape the balance sheets of corporations, the budgets of nations, and even the retirement plans of millions? Because if you want to survive and make money in this decades-long game, you must learn the art of distinguishing between the ripples of price volatility and the powerful undercurrents of durable economics. Oil market in the final months of 2025 bore no resemblance to its former self just 1 year prior. Brent crude, the global benchmark, was trading in the low $60s, while West Texas Intermediate hovered in the high $50s. These figures represented a staggering drop from the highs seen earlier in the decade. At the same time, from the world's leading energy agencies to its development banks, alarm bells about a potential supply and demand imbalance began to ring insistently. Demand growth in 2025 was anemic, at less than 1 million barrels per day. This modest figure, when combined with a steady stream of new supply, sparked a genuine fear. A scenario of a multi-million barrel per day surplus could become a reality as soon as 2026. On the supply side of this high-stakes chess match, OPEC Plus made a calculated move. They pivoted from aggressive quota hikes to a cautious pause. It was a clear signal that the major producers were balancing the drive for market share against the need for price stability. While some members agreed to a slight production increase in late 2025, they also signaled a halt to further increases in early 2026. Meanwhile, on the other side of the globe, major consuming nations like China made a complex move. They ramped up their crude stockpiling in October 2025, creating a temporary domestic surplus even as their long-term demand structure was already shifting towards electrification and petrochemicals. The picture becomes even more complex when we step back to view the macroeconomic backdrop. Prestigious institutions like the IMF, the World Bank, and the IEA all pointed to a broad-based decline across most commodity markets in 2025. Energy and certain base metals led this downturn, an inevitable consequence of slowing global industrial activity and the first impacts of the energy transition beginning to reshape medium-term demand forecasts. Both the World Bank and the IMF delivered bleak prognoses, projecting that the general commodity index would continue to fall throughout 2025 and into 2026. So why should we, as ordinary people, care about these complex figures and charts? Because the flow of oil still seeps into every corner of our lives. It affects the monthly electricity bill for every family, the budgetary balance of entire nations, and the very survival of giant corporations saddled with debt based on a certain baseline oil price. When prices fluctuate, winners and losers aren't decided overnight. They are forged over many quarters of real-world operations. Projects are shelved, budgets are revised, and dividends are cut. Our task, as observers and market participants, is to distinguish between a cyclical fluctuation and a structural change. To answer the question, is this a dip to be traded or a regime change to be weathered? And that subtle difference, that is the line between fortunes made and fortunes lost. Our story begins with a simple truth. Commodity markets move in cycles, and oil is no exception. For most of the modern era, the price of oil has been a complex symphony conducted by three main factors: physical supply, short-term demand, and the intangible expectation of future scarcity. And those expectations are not formless clouds. They are a complex map drawn by the pens of policy, the colors of technology, and the cost structure of the most marginal producers, the ones who set the market floor. In the short term, supply scarcity and geopolitical tremors are the hot colors, creating sudden tidal waves of price specs. But on a longer horizon, the game is dominated by billion-dollar investment decisions, the incredible flexibility of the shale industry, and the unpredictable elasticity of demand. The critical question, the one that always hangs over every trading floor, is this: what is the true value of a marginal barrel of oil right now? And who produces it, and at what cost? To find the answer, our story must dive into the numbers. In the third quarter of 2025, a glimmer of light appeared as global oil demand seemed to recover, growing by about 920,000 barrels per day year over year, a more favorable result than the market had endured in the previous quarter. However, it was merely a candle in the wind. The IEA and other major forecasters remained cautious, maintaining that full-year demand growth would not surpass the 1 million barrel per day mark. This was the weakest growth since the global financial crisis, barring major shocks. At the same time, on the other side of the scale, supply proved to be surprisingly abundant. The additional flow from OPEC's traditional production, combined with the powerful and flexible rise of shale operations in the United States, created a safety cushion large enough to ensure market stability. This combination of weak demand and plentiful supply acted like a massive gravitational pull, dragging the price floor far lower than the scenario everyone had hoped for: strong demand and constrained supply. History is always a great teacher. Let's look back at the ghost of the past, the years 2014 to 2016, after oil prices peaked near $110 a barrel. The explosion in U.S. shale production, coupled with OPEC's historic decision to defend market share rather than cut output, created a deluge that sank prices to a low of $30 in just 2 years. That shock forced producing nations to tighten their belts and rebalance their budgets. It slammed the brakes on capital spending for energy corporations and triggered a massive wave of consolidation. The lesson from then, which remains just as valid today, is that technology and capital, when combined, can change the rules of supply-side economics with blinding speed. Although the players in 2025 may be different, the script seems to be repeating itself. A flexible supply confronts an uncertain demand, and price becomes the most ruthless adjustment mechanism. And then, a turning point arrived. The shift that didn't happen on oil rigs or in pipelines, but within the mind of the market itself. The market began to reevaluate the value of underground reserves. The old gold standard of proven reserves, which was built on the assumption of stable prices and demand, now seemed fragile and uncertain. Investors increasingly turned their backs on the distant promise of reserves, craving something more tangible, something they could count this quarter: free cash flow and certain profits. When you change the metric of value, you change the entire game. The vast capital that should have been poured into long-term projects, mega projects that take decades to pay back, was now being rerouted to buy back shares, to pay dividends to impatient shareholders, or even to invest in a new future called alternative energy. As a result, the practical lesson for every investor in this story becomes clearer than ever. Seek out the sturdy ships that can weather the storm, companies with low financial leverage, short payback periods, and a proven ability to generate clear cash flow even at mid-cycle prices. For lenders and bondholders, this means scrutinizing the structure of covenants and cash flow projections more carefully than ever before. For the national treasuries of producing countries, it means building contingency plans for a prolonged low-price scenario, a scenario that is no longer a distant hypothesis. Most people underestimated the speed at which market psychology can shift, the speed at which the valuation pendulum can swing from reserves to returns. And finally, this story poses a philosophical question to every corporate board. Would you rather own an oil field that can be harvested for 30 years, but where the price future is as foggy as the morning mist, or would you rather hold a stake in a company that can deliver stable, predictable cash flow, quarter after quarter? And the market, with the invisible ballot of billions of dollars, appears to have made its choice. The pendulum is swinging toward the second option, the stability of quarterly cash flow. Corporate capital, like a river changing its course, is flowing away from the multi-decade projects and towards fertile grounds that can be harvested quickly. This momentous shift will write one of two scripts for the future. Either it will make the current downturn a brief nightmare before supply tightens again, or it will plunge the entire market into an era of low price that lasts longer than we think. And we are about to witness the first signs of that choice, not through speculation, but through the numbers that don't lie in corporate financial statements and government balance sheets. Because oil has never been just a commodity. Is a chess piece on the geopolitical board, an instrument of statecraft, and the financial foundation for many nations. The reaction of governments to price changes is just as critical as the reaction of corporations. Some nations, like sturdy ships, have prepared enormous reserve funds and sovereign wealth funds to ride out the storm. But other nations have not. And when the storm hits, the entire financial system, from hedging contracts and government bonds to the hidden risks of oil royalties in the banking system, will all resonate and amplify the initial shocks. History has shown that a sharp price drop is often the starting gun that forces producing nations to slash budget spending, and that often ignites smoldering geopolitical fires. In this year, 2025, some producers are facing an impossible balancing act. On one side, social commitments that cannot be abandoned. On the other, oil revenues that are shrinking by the day. International lenders and the bond market are watching every heartbeat, scrutinizing their fiscal break-even points. Credit rating agencies, the gatekeepers of the capital market, begin to adjust their outlooks, and every downgrade means the cost of borrowing for vulnerable nations goes up, tightening the financial noose. But on the other side of the globe, a different story is unfolding. Some consuming nations are benefiting. Lower import costs have helped them improve their current account balances and, more importantly, have boosted the real income of every household. This is a global redistribution of wealth. The flow of assets is reversing from producers to consumers, and it carries with it profound consequences for both the distribution of benefits and political power. To see this clearly, remember that many oil-dependent budgets were built on an assumed oil price far higher than today's reality. A swing of just $10 or $20 per barrel is not just a number. It can mean billions of dollars in evaporated revenue each year for major exporters. The real turning point will be revealed in policy decisions. Will producers accept reality and courageously adjust spending, or will they try to borrow their way through the pain to delay the inevitable? If they cut spending, social and political tensions could escalate. If they borrow, the credit market will be the judge of that debt's sustainability. At the same time, financial investors, from giant banks to nimble hedge funds, will begin to recalibrate their risk appetite, and the feedback loops can be viciously fast. A credit downgrade drives up bond yields, increasing fiscal pressure on the government, and potentially depressing investment even further, creating a downward spiral. The consequence of all this is a range of possible scenarios for the future. It could be a multi-year period of stability with oil hovering around $60 or $70 and a slowdown in global capital spending. Or it could be a deeper, more structural change where demand plateaus and only the lowest cost supply survives. Which path we take depends on the policy decisions made in closed-door meetings, on the pace of technological adoption on oil rigs, and on the speed at which global supply adjusts to a permanently altered demand picture. The final lesson for both investors and policymakers is to prepare for multiple scenarios, to constantly stress test their core assumptions about price, growth, and social spending. Most observers are just waiting for the next big headline, but the real story is being written by the undercurrents we have just explored. So, where should we, the seekers of the investing compass, look? While the crowd is busy chasing breaking headlines, wise investors are quietly turning to different documents. They are not looking at daily price charts. They are looking at balance sheets. They are searching for the break-even points of governments, and they are scrutinizing every line in the cash flow statement. They ask simple but vital questions. Which government can maintain a budget surplus at $60 well, and which will be plunged into deficit? The answer to that question, not some tweet, will determine geopolitical stability in several regions of the world for years to come. The final test of this cycle will not be the price of a barrel on any given day. The real test will be in corporate cash flow statements, in the resilience of national budgets, and in whether the market's marginal barrel of oil is produced by policy or by the iron laws of the market. The coming quarters will reveal which force has the upper hand. And so, we've analyzed the three main axes that will determine whether the current downturn is temporary or structural: the identity of supply, the trajectory of demand, and the capacity for fiscal and political resilience. The short-term indicators paint a conflicting picture: modest demand growth, OPEC+'s tactical pause, China's unpredictable stockpiling, and the improving break-even of shale. It all points to a market teetering on a fragile line between a cyclical downturn and a long-term transition. Organizations like the IEA warn of a potential supply glut, while global commodity indexes show a general weakness in 2025. Both are signals that the market is unlikely to see a swift recovery. So, what plausible scenarios should a prudent investor prepare for? Scenario 1, the simplest, a rebalancing. Demand modestly recovers, OPEC Plus skillfully manages production to prevent a major surplus, and prices find a new anchor, stabilizing in the $60 to $70 range. Scenario 2, at prolonged softness. Demand remains weak, while the ever more efficient shale industry continues to add supply economically. Prices get stuck in the low to mid $60s for years, creating a favorable environment for low-cost producers and the art of efficient capital management. And Scenario 3, the volatility scenario. Geopolitical shocks temporarily disrupt supply, creating infrequent price spikes, but failing to sustain a stable high price level. None of these scenarios is impossible, and a prudent strategy will prepare for all three. Prioritize companies and countries with low fiscal break-evens and the ability to generate strong cash flow. Value efficient capital management over aggressive reserve replacement at all costs. In a portfolio context, it means hedging against financial outcomes in major exporting countries and focusing on balance sheet strength. For policymakers, the lesson is to build up buffer funds and have the courage to adjust spending assumptions. For corporations, prioritize returns and the ability to survive prolonged downturns over chasing hypothetical high prices. The market always holds surprises, but history shows that the ultimate winners are often those who embrace uncertainty, who focus on sustainable cash flow, on prudent safety margins, and on clear-eyed stress tests. The oil market is changing, and whether this downturn becomes a full-blown crisis or just a necessary correction depends not on the headlines, but on the decisions being made right now in boardrooms and budget offices around the world. And that is our story for today. A story that reminds us that investing is not about prediction, but about preparation. If you enjoy these kinds of in-depth financial stories and want to continue this journey with the Omaha Compass in search of wisdom, don't hesitate to hit that subscribe button and ring the notification bell right next to it. And of course, giving this video a like is an invaluable source of motivation for us to continue creating more quality content. Please leave a comment below letting us know which scenario you think is most likely to play out. Once again, thank you for tuning in. I'm your host, goodbye, and until our next journey together on the Omaha Compass.